Hello, my name is Julian Seymore. I am an investment consultant with HBAN and also a business consultant with Dublin Business Innovation Centre. The purpose of my talk this afternoon or this evening, depending on when you're viewing, is to give you an insight into, I suppose, the realities of raising investment for your business. You're all early stage business and new frontiers, and some of you want to raise investment, some of you won't want to raise investment. Neither is what you say can be seen as a good thing or a bad thing. It's very much down to what you want for your business. Just a quick little overview of Dublin Bic. For those of you who don't know, Dublin Business Innovation Centre, our mission is around empowering entrepreneurs to start and scale. So we're embedded in the startup ecosystem alongside Enterprise Ireland, alongside the local enterprise offices, whom you'll also see videos from as part of this program. There's four core things that we do. Number one, we work on investor-ready preparation. So what that means is we work one-to-one with companies, mostly who are on the Enterprise Ireland high potential startup track, but companies who are serious about scaling and scaling the business internationally. We help them get investor ready by working one-to-one with them to develop out their investor documentations. That's their business plan, their financials, their pitch deck, to a grade where they stand up to robust investor scrutiny. The second thing we do, which is the primary focus of my talk here, is we manage a number of finance channels or funding channels. So when we talk about access to finance, what do we mean? Well, we have two seed funds. We manage the AIB Capital Fund, which is an older fund, not taking on any new investments. And we have the Ireland Smart Tech Fund, which is part of Dublin Bic Ventures, which is a new seed fund recently launched at the start of this year, which is a 23 million euro fund for investing seed capital in businesses. And we also run the Halo Business Angel Network, which is the all-island angel investor network, of which I spend probably about 60% of my time working with angels, bringing them investment opportunities, or bringing investment opportunities to pitch to angels. The third thing we do, very briefly, is around world-class incubation. So we manage the Guinness Enterprise Centre, which is currently undergoing a big extension to grow from what is now 100 businesses working there to 200 businesses and up to 750 employees based there. We also manage a number of enterprise spaces. So we have space at Dublin Bic, which is located in Kevin Street. And the final thing we do is around community collaboration. So we run a number of ecosystem events. One which you may be familiar with this year is our online funding and scaling series. We also ran Future Scope for the last number of years, which some of you may have attended. As I mentioned, there's three main areas that we deal with regard to finance. We work in tandem with Enterprise Ireland, obviously very closely, and also with the local enterprise office. Very quickly, the Ireland Smart Tech Fund, part of Dublin Bic Ventures, was launched in 2019, late 2019. It tends to invest about 30 companies over the next 5 years. The AIB Capital Fund was a 53 million fund, co-managed by Dublin Bic. Its primary investment period ended in 2015, but it's still doing follow-on in its existing portfolio. There's been a number of follow-on investments that have occurred over the last number of years there. And then finally, the Halo Business Angel Network, which is probably the most likely source of private investment for you if you do intend to go and raise seed finance. It's the all-island angel network of angel investors. We have about 500 active angel investors in this network, and they're spread across 12 different groups, 10 of which are in Ireland and 2 which are overseas in London, New York. So the average angel round is typically around 250K invested into a company that's raising usually between 550 and 600K. So getting to the focus of this talk and startup funding options. So there are a range of options. Some of you may have already engaged in these. In fact, if you're on New Frontiers, you're probably in the bottom left-hand quadrant of this this graph where New Frontiers would be classified as an accelerator. And there's a lot of early stage funding from local enterprise offices, and indeed where your friends or your family invest. All of these are what's known as pre-seed stage. The focus of my talk here is to talk more about seed stage and beyond. Now, business angels will exist in the pre-seed and the seed stage, but the track that most of you are on going through this program may be towards moving towards Enterprise Ireland high potential startup funding, and possibly going on to raise seed or venture funding. All these funding mechanisms, I suppose, are a mix of, the experience of them really varies. And as you raise more and more funds, the desire for control and information and the intensity, I suppose, of the relationship that you have with investors is much heightened. Typically down at the lower stage where you pre-seed, there's not really a desire for control or information from the investors at this level. So what's the best startup funding approach? Well, there's a lot of talk in the startup world about raising money, and that raising money somehow equals good, and not raising money is somehow perceived as not being successful. Most successful businesses that do go on to raise money quite often are ones that have bootstrapped for some time and have generated a large amount of revenue or substantial revenue and built a strong investment case. And generally these companies tend to achieve higher valuations with investors because they've de-risked the business. So the more you can bootstrap to raise before you raise funds, the stronger the investment case for your business. It's quite normal for high potential startups to go through several investment rounds. And it's pretty uncommon that high potential startups are going to become self-sustaining for the first round. And investors generally do not expect this. But what they do expect is that when you raise funds, they take you to a certain level or a key inflection point where then the value in your business increases, and then you can raise funds at a higher level or a higher valuation, and therefore manage the risk for investors. So what is seed or venture capital? In quite simple terms, it's risk funding, which means it can be lost, but then with the risk comes the upside, and it's risk funding for equity participation. It's long-term committed funds which are there to help your company grow and succeed. Generally with seed and venture capital, the investors can get actively involved. Now, what active involvement means is it could be one day a month. They may provide support in terms of opening up their own networks or connections, advising management, sharing experience on how to navigate some of the difficult things in growing a business. So generally investors come from an experienced background and have that experience to share. For all seed and venture capital, the downside to this risk is that they can lose their money. And in return for that risk, they're looking for an upside where they can ideally turn their investment into 5 to 10 times what they invested. So they're looking for high multiple investors on investment. I suppose in a portfolio, typically the ones that do very well are colloquially known as stars. For seed funds to make a positive return, each investee has to be a potential star. So if they're going to invest in 10 companies, all of them have to have the capacity at the stage of pitching to give confidence to the investor that those companies can potentially deliver up to 10 times the investment amount that's gone into them. The difference between seed funds and angels varies a little bit, but there's actually quite a lot of similarities. But generally, seed funds and VCs have deeper pockets and the ability to follow on in deals. Typically, angels invest somewhere between 50,000 and 250,000, occasionally a little bit more. But the average angel investment round is around 250K in our experience, in a round of somewhere around 600,000. Quite often, when companies are going to raise seed investment, they'll look for a deal lead or someone to lead the investment round. Whoever leads the investment round generally sets the terms of the round, the terms and conditions of the investment, including the valuation. Business angels occasionally lead, but quite often will follow the term sheets and the valuation set by seed funds or VCs. It's rare that a business angel will look to be a director of your company. Occasionally they may look to be a board observer, but generally with the seed fund, they definitely will take a position on your board and have voting rights on your board. This is by virtue of the fact they usually offer or invest higher quantums in your company. Both groups are looking for a similar return. So at a minimum 5 times the money back, ideally somewhere between 5 and 10, and ideally closer to 10 or above 10. So what stage do you raise investment? Well, really, you've got to have a minimal viable marketable product. And so when I'm talking about raising investment here, I'm talking about raising investment at the seed level, not at the pre-seed level. So ideally, you have to have a product in the market. Ideally, it's generating a little bit of revenue, but particularly if you've got software in an online business, it's definitely got to be in the marketplace with early stage customers paying for it. Investors don't want to spend a large amount of their money being spent on R&D. What they do want to see is early market validation. So sales obviously is the best early market validation, but they do want to see early customer adoption. And if they're not paying customers, they do want to see that it works, that it's been validated by your wider channel, not just your customers, and that you have some level of sales growth metrics and certainly a sales process in place, even if it's only for the last couple of months, that they can see that there's a trajectory and a trajectory in the right way. The business model is really, really important for considering investment. Obviously, this will evolve over time, not just post-seed investment, but even before seed and after the seed investment. Business model constantly develops as you look to find the best product market fit and the best route to market. What is really important is that there's a detailed plan behind the ask for investment. So showing an investor an idea and hoping they're going to invest in the awesomeness of your idea is not going to be enough in itself to raise investment. They want to see a detailed business plan that's coherent, that makes sense, and they want to see a committed, balanced team. Usually it's only going to be 2 or 3 people at the start, but it's really important to see that the team are committed to growing the business. So in terms of raising funding, how should you go about raising funding? Well, first of all, it's important to realize that it takes a long time to raise funds. So ideally, you want to be looking for 15 to 18 months runway for those funds. The funds have to set out clear de-risking or value creating milestones from the seed round, and they should support the company raising follow-on investment at a higher valuation. So as per the previous slide, it's really important that the funds get you to a value creating or key inflection point where the overall value in your business is raised. It's important not to risk being undercapitalized. Investors are going to discount your sales projections, so keep your overheads as low as possible until sales really kick in. As ever, include contingencies. I haven't seen a business plan that doesn't spend more and bring in less in terms of sales. So what's the process for raising funds? Well, it's a multi-stage process, but the first contact usually comes with the pitch, and thereafter a business plan and some financials. There'll be some surface level due diligence will be done, and if there's interest, that will proceed to probably a series of meetings and requests for information. So it's really important that you have this information readily available and accessible, and usually that comes in the form of a data room, which could be a Dropbox or a Google Drive, that you can share with investors. Once they've confirmed their interest to invest, then they look to agree a term sheet, which is the basics or the heads of terms of which they're going to invest in your company. Once they've signed the term sheet, they may do further due diligence before moving to a shareholders agreement. This is also called a shareholder subscription agreement. And thereafter, they move to completing the investment. The time frame varies greatly, so you should allow at least 6 months to close an investment round. So what are term sheets? In simple terms, they set out the key terms and conditions of investment. These specifically are the valuation and the shareholding structure, what the investment instrument is going to be. Will it be convertible loan note or ordinary shares? If it is a convertible loan note, how will that convert? Is there an employee share option pool created? And what anti-dilution rights will the investors have? Nearly always the legal costs will be paid by the investee company. So any costs incurred by the investor will be passed on to the investee company and usually deducted from the sums raised. In terms of valuation, this is always one that people are very interested in. I think it's important to realize that it's very much art rather than science. And there's certainly at the stage that you're at, there is no model that you can use or no equation or formula. So it's going to be driven by a series of factors, both qualitative and quantitative. They'll look at the team first and foremost. They look at your product and how differentiated it is, what sources of competitive advantage you have and how defensible it is. They look at your traction to date, how big is the market opportunity, and what your burn rate is for the cash that you're going to raise, and will you need further follow-on investments. So there's a number of variables, but the valuation is also a function of how much you're going to raise as well. It's important not to put investors off with a really, really high valuation on the first interaction with them. So get the meeting, talk to investors, get their confidence in you, and then move towards discussing valuation. As mentioned, there's a number of ways investors can invest. They can invest through ordinary shares. Typically, angel investors or private investors will invest through ordinary shares. Some of them may offer tax relief. The two other ways are convertible preference shares, which is the way Enterprise Ireland will invest if they're investing under the HPSU program, and convertible loan notes, which are essentially a loan that converts to equity at a later date. Both convertible preference shares and convertible loan notes have a range of terms and conditions around the conversion. It's probably not a subject for today, but just to be aware that there is a level of complexity with these, and as far as practicable at the early stages of your business, you should look to have ordinary shares in place. It's important that if you're serious about really scaling this business, that you create an employee share option pool. This is used to give equity to employees, and usually that's in lieu of being able to pay them significantly higher salaries. It also ensures their commitment to the company, and it's fundamental to helping build the business. In terms of deal leading, which I mentioned earlier, should I say, when there is a VC in place, they'll usually lead the investment process. So they'll set the valuation, they'll set the terms, and they'll agree legals and the fundamentals around the shareholders agreement. Angels will generally follow, and Enterprise Ireland will also usually follow in and liaise with the seed funds in completing the legals around the investment. It's important to try and get to the stage of having a term sheet and a lead investor, because often once you have this and once the terms of your investment in your company is set, it will make it easier to go out to other investors who will then have the option to take it or leave it with regard to investment in your business. If you don't have a term sheet, then quite often you're stuck in negotiating price and the value of your business without any concrete feedback or response from the investor. And so quite often investor conversations can turn into never-ending conversations because there is no term sheet in place. So some final points on raising investment. Raise a seed round when you're ready, not when you have to. This is a really important point. There's nothing worse from an investor point of view, seeing a company that's very desperate to get investment. So plan out your round well, but do try and bootstrap as long as possible. It usually does take longer than you think. And it's important that you do your own due diligence on investors. So it's a two-way thing. Getting investors, like getting into a relationship and beyond your immediate familiar relationships, probably one of the most significant business relationships you'll ever be in. So get to know your investors well, see what sectors they invest in, how they work, how they can add value, and importantly, can they follow on in later investment rounds? It's important when you're engaging legal expertise that use legal expertise that's experienced in this space. A lot of solicitors won't know or understand this and may put you on the clock and charge you substantial fees for things that don't really need to incur fees. So make sure you work with a legal representative that really understands the startup process. And finally, be prepared to be distracted from the important job of running your company. So raising money takes a lot of time, and balancing that out with growing your business, trying to move your business on to the next value inflection point is very, very difficult. So make sure to keep an eye and manage your time carefully, that you keep the business going in the right direction while still raising funds.